You were told something that sounded professional, something that made trading feel structured, safe, almost mathematical. Risk to reward ratio. Only take trades with 1 to 2, 1 to 3, 1 to 5 setups. It sounded like control. It sounded like discipline. It sounded like the missing piece between you and consistency. But nobody told you the part that matters most. It only works, in theory, not in your emotions, not in your execution, not in your real trading account where fear, greed, revenge, hesitation, and hope are constantly rewriting your decisions in real time. And deep down, you already know this. You've just been trying not to admit it, because admitting it would mean facing something worse than losses. It would mean facing the fact that you built your entire trading mindset on something that feels clean on paper, but collapses under pressure. Let's be honest about what really happens. You don't lose because your risk-to-reward ratio was wrong. You lose because you never actually execute it the way you planned. You enter a trade with a perfect 1 to 3 setup. You tell yourself, this is it. Clean stop loss, defined target, everything planned. And for a few minutes, you feel like a trader. Then price moves against you. Just slightly. Not enough to hit your stop, but enough to shake you. And that's where the real trade begins. Not on the chart. In your mind. You start negotiating with yourself. Maybe I should move the stop a little. It's just liquidity hunting. It will come back. I can't take another loss today. And in that moment, your risk-to-reward ratio is already dead. You just haven't buried it yet, because now your risk is no longer defined, and your reward is no longer realistic. You are trading emotion disguised as strategy. Let's go deeper. There was a trader, let's call him Adam. He started like everyone else, watching YouTube, reading trading quotes, learning risk-to-reward ratios like gospel. He built a system, 1 to 3 setups only, no exceptions. He felt disciplined. He felt different. The first week, he took 7 trades, won 3, lost 4. On paper, still profitable. But something happened. The losses hurt more than the wins felt good, because each loss felt like a failure of discipline, not just probability. So he adjusted. He started filtering better. He stopped taking setups that were not perfect. Now he was taking fewer trades. More confidence, he thought. But now something else started happening. He would see a setup, but hesitate. He'd wait, miss the move, then watch price go exactly to his original target. And that's where frustration entered. Not loss, frustration. And frustration is where traders begin to destroy themselves, because frustration always demands revenge. So Adam did what every trader eventually does. He broke his own rules, quietly. At first it was small, a slightly bigger lot size, a slightly wider stop, a this one feels good trade. Then one day he took a trade that didn't even meet his rules, but it looked obvious. It moved fast. It worked. And that win destroyed him more than any loss ever could, because now he had proof that rules were optional, that discipline was flexible, that feeling could replace structure. And that is where the illusion of risk to reward truly begins. Because risk to reward ratios don't fail you in losing trades. They fail you in winning ones you didn't deserve. Now let's talk about what nobody tells you. The market does not reward clean ratios, it rewards execution under pressure, and most traders cannot execute under pressure. They can only plan under calm conditions. That's why backtesting feels powerful. That's why demo trading feels easy. That's why screenshots of perfect trades look convincing. But live trading is different. Live trading is emotional distortion in real time. You are not just trading candles, you are trading your nervous system. Let's be real about another moment. You take a 1 to 2 trade, stop loss, $100. Target, $200. Price goes in your favor quickly, you're up $120. Then it pulls back to plus $40. And suddenly your brain changes the game. Now you're not thinking in risk to reward anymore. You're thinking, I don't want this to turn into a loss. So you close early. You take $40 instead of $200, and you call it discipline. But it wasn't discipline. It was fear disguised as control. Now repeat this 20 times. You will notice something. Even if your strategy is technically profitable, you are not capturing the profit because risk-to-reward ratio assumes emotional neutrality, and traders are never emotionally neutral. Another trader, Sarah, learned this the hard way. She had a 1-to-3 strategy, strict, clean. She journaled everything. She studied like a student. For 3 months, she was barely profitable, but consistent. Then something shifted. She started getting tired of small wins and small losses. She wanted better execution. So she tightened rules. Only A-plus setups. Now she was taking fewer trades. But each trade meant more to her mentally, and that's where the problem started. Because when frequency drops, emotional weight increases, every trade becomes meaningful. Every trade becomes personal. And once trading becomes personal, you stop thinking statistically, you start thinking emotionally. She took a trade one evening. Everything aligned. Entry was perfect. Risk was defined. Reward was 1-to-4. It started going in her favor. She felt relief, then confidence, then expectation, then fear of losing it. Then she moved her stop to break even too early. Then price came back, stopped her out, then went to target. That one trade broke her more than losing money because it destroyed her belief in the system. But the system was never the problem. Her execution under emotional pressure was. Now let's expose something uncomfortable. Risk-to-reward ratio is not wrong. It is incomplete. It assumes you will always follow your stop loss. You will always hold winners to target. You will never interfere emotionally. You will never hesitate. You will never get greedy. You will never get scared. But real traders do all of that. So what actually happens? You don't get your planned 1-to-3. You get something like 1-to-1 winners cut early, 1-to-2, trades turned into break-even 1-to-3, setups scratched or stopped prematurely, occasional runner that you overstay and turn into loss. And then you wonder why your equity curve looks nothing like your plan. It's not because your ratio is wrong. It's because your behavior is inconsistent. Now here's the part that hits hardest. Most traders don't fail because they lack strategy. They fail because they keep searching for a system that survives their emotions instead of fixing their emotions to survive the system. They want a holy grail that removes responsibility. Risk-to-reward ratio feels like that grail. It feels like math will protect you from yourself, but it won't, because the enemy was never the market. It was your reaction to the market. Let's go into a real scenario. A trader enters EUR/USD. Risk, $100. Reward, $300. Price moves up. He's in profit. Then news hits. Spread widens. Candles spike. He panics. Closes early at plus $60. Later, price continues exactly to target. He feels anger. So next trade, he tries to make it back. Same setup. But now he increases risk to $200 because he wants to recover faster. That trade loses. Now he is not thinking about risk to reward anymore. He is thinking about survival. And survival thinking destroys structure. This is how accounts don't die in one trade. They die in the emotional chain after a single broken expectation. And that expectation often starts with belief in perfect risk-to-reward execution. Let's be even more direct. If you cannot hold a winning trade without interfering, your risk-to-reward ratio is meaningless. If you cannot accept a loss without emotional reaction, your risk-to-reward ratio is meaningless. If you change decisions mid-trade, your risk-to-reward ratio is already dead before the trade ends. So what is the truth? The truth is this. Risk-to-reward ratio is not a strategy. It is a measurement. It tells you what should happen, not what you will do. And there is a massive gap between those two. That gap is where most traders lose everything. Now think about your own experience. How many times have you entered a trade with a perfect plan and exited with a different outcome than planned? Not because the market changed, but because you changed. That is the real trading story nobody writes in textbooks. The market doesn't betray you. Your execution does. And the most dangerous part? You still blame the ratio. You say, I need better setups. I need higher win rate. I need 1 to 5 trades only. But deeper down, you already have enough strategy. You don't have discipline under pressure. Let's end with something real. There is no magical ratio that saves undisciplined execution. There is no number that protects emotional inconsistency, and there is no system that survives repeated interference. If you keep believing risk to reward is your edge, you will keep looking for better setups instead of becoming a better executor. And that search never ends. Because the problem was never in the math. It was always in the moment you decided the math would replace your behavior. And that is the lie you keep believing.